Let's take a look at some stock basis questions here. Here's the problem. Determine the basis of stock in the hands of the shareholder in each of the following instances. Assume that the 80% rule is met in all cases. Okay, now the first one says contribution of property had a basis of $1,000 and a fair market value of $1,400. First I want to point out the general rule. Okay? And the general rule is the basis of the stock in the hands of the shareholder is equal to the basis of the property contributed plus any gain recognized minus any boot received. Boot, of course, is cash you receive. Boot includes any relief of liabilities as well. So, in the case of $1,000 and a fair market value of $1,400, let's take a look. Using the rule, we know that the basis is equal to the basis of the property contributed, so it's $1,000. There's been no gain recognized, no boot received, so A is pretty straightforward. Okay, then we look at B, and now we have property with a we have a contribution of property with a basis of $3,000, fair market value of $3,800. The stockholder also received $500 cash from the corporation as part of the stock transaction. Okay, so it gets a little bit more sophisticated, but we can solve it. All right, the shareholder will have to report the gain of $500, which is the lesser amount of the gain of $800 and the fair market value of the property received of $500. Okay? And then the shareholder will have a basis in the stock equal to $3,000 plus $500 less $500 or $3,000. All right, now we'll take a look at C. C says we had a contribution of property with a basis of $8,200, a fair market value of $12,500. The stockholder also received property with a fair market value of $1,700 from the corporation as part of the stock transaction. All right, so using the general rule, we reach this solution. It's very similar to B above. The shareholder will have a gain of $1,700. The shareholder's basis in the stock becomes the $8,200 original basis plus the $1,700 minus the $1,700. So he's back to $8,200. Okay, and then D says, now there's a contribution of a building with a fair market value of $200,000, a mortgage of $100,000, and a basis, and that should say of, by the way, of $125,000. So let's see how we would solve D. All right, so D, how we would solve that is the shareholder doesn't have to report a gain because the debt is not in excess of basis. Okay, the debt's $100,000. The basis of the building was $125,000. There's no gain to be reported. The basis in the stock then would become the $125,000, which was the basis of the building, less the $100,000, which is the mortgage assumed. So that essentially becomes equivalent to receiving cash. So he's got a stock basis of $25,000. And then E says, now what if there was a contribution of a building with a fair market value of $1,700,000, a mortgage of $1 million, and a basis of $635,000. All right, let me move this out of the way. We're looking at the right part of the screen there. There we go. Okay, so part E says, given that there was a contribution of a fair market value of 1.7, a mortgage assumed by the corporation of $1 million, and a basis of $635,000, the shareholder will have to report a gain equal to the excess of the assumed debt over the basis. So it's $365,000. Well, how do we come up with that? It had a basis of $635,000. There is there's a gain of $365,000. That's the $1 million that the corporation assumed minus the basis of 635. So that's where that shareholder gain would have to be reported. And then the basis in the stock would be 0. The 635 original basis plus the 365 gain, right, less the $1 million of assumed liability that the corporation picked up. Okay, now the screen moved a little bit for you. We're going to tackle the next question, which says, using the information from problem 47, and I've put that information labeled A through E on the screen there so you can see it, we need to determine the basis of the property contributed in the hands of the corporation in each instance and assume the 80% rule is met in all cases. Okay, well, again, the general rule is that the basis of the property in the hands of the corporation is equal to the basis in the hands of the shareholder plus any gain recognized. So, there was no gain recognized on A. The basis becomes $1,000. In B, where we're talking about property worth $3,000, fair market value, or a basis of $3,000, fair market value of $3,800, and the stockholder receives $500 from the cash contribution, then the basis becomes the $3,500. The basis of the person contributing, or the party contributing, plus the gain that was recognized by the shareholder. All right, now in Part C, we had $8,200 of contributed property, right? A basis of $8,200, fair market value of $12,500, and the stockholder received property with a fair market value of $1,700 in exchange for the what he contributed. So we're talking about $9,900 would be the basis in the property from the hands of the corporation. So we've got the carryover basis of the $8,200 plus the $1,700, which was the gain he received by the shareholder. Okay, then on D, it's $125,000, which is the, let's go through the facts again. Fair market value of $200,000, a mortgage of $100,000, a basis of $125,000. Now the basis stands because there was no gain recognized by the shareholder. And then I'll move this away entirely, and we'll tackle Part E. I'm going to slide this away, and hopefully my screen won't slide on us like it did last time. Okay, and we come up with $1 million. Well, how do we come up with that? We had a fair market value of $1,700,000, a mortgage assumed for $1 million, and a basis of $635,000. So the carryover basis of the $635,000 becomes the basis for the corporation. Plus, we know that the shareholder recorded a $365,000 gain. Okay, that takes care of these stock basis questions and answers.